Preparing for an accounting at Kraft Heinz interview, you've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How do the three financial statements connect? I start with the accounting equation: assets equal liabilities plus equity. A transaction changes at least two accounts, so debits and credits preserve that balance. For Kraft Heinz, selling packaged food increases cash or receivables and revenue, while costs reduce inventory and profit. Net income flows through retained earnings, and the cash flow statement reconciles earnings to operating, investing, and financing cash movements. I would always connect the journal entry to the balance sheet and performance impact. While answering, focus on the accounting equation: how net income flows into retained earnings, how working capital affects operating cash flow, and how investing and financing activities explain changes in cash. Question 2. How would you determine when Kraft Heinz should recognize revenue? The key question is when control of the product transfers to the customer. I would identify the contract, determine the performance obligation, establish the transaction price, allocate it when necessary, and recognize revenue upon satisfying the obligation. For Kraft Heinz, customer rebates, coupons, promotions, and returns create variable consideration, so estimates must be constrained and updated each period. I would also reconcile recognized revenue to shipments, invoices, deductions, and subsequent cash collections. Make sure to cover the 5-step revenue model: performance obligations, transfer of control, variable consideration such as rebates and promotions, and the importance of estimating returns or discounts accurately. Question 3. How does inventory accounting affect Kraft Heinz's financial statements? Inventory accounting determines when product costs become expense. I would discuss raw materials, work in process, finished goods, standard costs, overhead allocation, and adjustments for production variances. If inventory becomes obsolete or its net realizable value falls below cost, Kraft Heinz records a write-down, reducing inventory and current period earnings. A higher ending inventory generally lowers cost of goods sold and improves profit, but it does not create operating cash. Cash flow depends on purchases and working capital movement. In your answer, talk about inventory costing, standard costs, overhead allocation, lower of cost or net realizable value testing, obsolescence reserves, production variances, and the impact on gross margin and cash flow. Question 4. How would you test Goodwill for impairment? Goodwill impairment asks whether a reporting unit's carrying value exceeds its estimated fair value. I would review projected revenue, margins, discount rates, market multiples, and operating trends, then perform sensitivity analysis around the key assumptions. For a branded food business, weaker volume, lost shelf space, or sustained margin pressure could reduce valuation. An impairment charge lowers goodwill and earnings, but it is non-cash. I would explain its effect separately from underlying operating cash generation. Be sure to mention reporting units, carrying value, fair value, cash flow forecasts, market multiples, discount rates, sensitivity analysis, and why impairment reduces earnings without directly reducing cash. Question 5. What is the difference between goodwill and identifiable intangible assets? Identifiable intangible assets can be separately recognized when they are identifiable and reliably valued, such as trademarks, technology, or customer relationships. Finite-lived assets are amortized over their useful lives, while indefinite-lived brands are not amortized but require impairment testing. Goodwill is the residual purchase premium after allocating consideration to identifiable net assets and liabilities. At Kraft Heinz, strong brands may be strategically important, so I would connect valuation judgments to both reporting and acquisition analysis. Focus on how acquired brands, trademarks, customer relationships, and goodwill arise, the distinction between finite and indefinite lives, amortization, impairment testing, and acquisition accounting implications. Question 6. How would you account for a customer rebate or promotional allowance? I would generally treat a customer rebate or promotional allowance as a reduction of the transaction price, unless the customer provides a distinct service. At shipment, Kraft Heinz should estimate the expected rebate using contract terms, historical redemption rates, and current promotional activity. The estimate creates a liability or reduces receivables, with later true-ups when claims are received or experience changes. I would validate the accrual against contracts, customer deductions, subsequent settlements, and management review. While answering, cover the reduction of transaction price, estimation methodology, contract terms, historical experience, accrual timing, true-ups and controls over customer deductions and promotional claims. Question 7. How would you explain the difference between operating cash flow and net income? Net income is accrual-based, whereas operating cash flow reflects cash collected and paid during the period. Starting with net income, I would add back non-cash expenses such as depreciation, amortization, and impairment, then adjust for working capital. Rising receivables or inventory consumes cash, rising payables provides cash. Therefore, Kraft Heinz could report solid earnings while operating cash flow weakens if inventory builds ahead of demand or customers take longer to pay. Make sure to cover non-cash charges, working capital movements, the indirect method, inventory and receivables, payables, and why profitable growth can temporarily consume cash. Question 8. How are leases recorded under current accounting standards? At commencement, a lessee generally records a right-of-use asset and lease liability based on the present value of committed lease payments. I would assess the lease term, renewal options, payment escalations, and appropriate discount rate. Operating leases typically produce a single lease expense, while finance leases separate interest and amortization. For Kraft Heinz, facilities, warehouses, and equipment leases can materially affect obligations, so I would reconcile the lease system to contracts and the general ledger. In your answer, discuss right-of-use assets, lease liabilities, discount rates, operating versus finance lease expense, renewal judgments, and the effect on EBITDA, debt metrics, and cash flow presentation. Question 9. How do foreign currency movements affect Kraft Heinz's accounting? I separate transaction exposure from translation exposure. A foreign currency receivable or payable is remeasured at the reporting date, with the resulting gain or loss generally recognized in earnings. A foreign subsidiary's financial statements are translated into the reporting currency, with many translation effects recorded in accumulated other comprehensive income. Because Kraft Heinz operates internationally, currency changes can affect reported revenue, margins, assets, and debt metrics without representing the same change in local currency operations. Be sure to mention transaction versus translation exposure, functional currency, remeasurement, foreign exchange gains or losses, accumulated other comprehensive income, and hedging considerations. Question 10. What creates deferred tax assets and liabilities? Deferred taxes arise because accounting and tax rules recognize income or expenses at different times. A deferred tax liability may result when book depreciation is slower than tax depreciation, while a deferred tax asset may arise from accruals, carryforwards, or stock compensation. I would assess enacted tax rates and whether future taxable income supports realization, otherwise, a valuation allowance may be needed. The accounting entry reflects future tax consequences, not necessarily current period cash taxes. Focus on temporary differences, book versus tax timing, deductible losses, valuation allowances, tax rates, realizability, and how deferred taxes affect the balance sheet without immediately changing cash taxes. Question 11. How would you account for a restructuring or cost-saving program? I would not accrue a restructuring simply because management approved a plan. Recognition depends on the specific obligation and applicable guidance. Employee termination benefits, contract exit costs, and asset impairments may have different timing and measurement requirements. I would document approved actions, affected employees or facilities, expected payments, and evidence of communication. For Kraft Heinz, I would also distinguish the accounting charge from the operational savings, since savings may arrive gradually and require separate validation. Make sure to cover whether an obligation exists, recognition criteria, employee termination benefits, contract exit costs, asset impairments, timing, estimates, and separating one-time charges from recurring savings. Question 12. What internal controls are most important in a public company? Close. Strong close controls prevent errors before they reach the financial statements. I would prioritize reconciliations for cash, receivables, inventory, accruals, leases, and intercompany balances, independent review of manual journals, restricted system access, and documented review of significant estimates. At Kraft Heinz, controls over trade promotions, inventory reserves, acquisitions, and impairment models would deserve particular attention. I would test both whether the control is properly designed and whether it operated consistently throughout the period. In your answer, discuss account reconciliations, journal entry approval, segregation of duties, estimates, access controls, review evidence, unusual transactions, and how controls support accurate and timely reporting. Question 13. How would you investigate an unfavorable gross margin variance? I would decompose the variance into price, volume, mix, input costs, manufacturing, freight, promotion, and foreign exchange effects. For example, a favorable price increase could be overwhelmed by commodity inflation or a shift toward lower margin products. I would compare actual results with budget, prior year, and operational data, then investigate unusual standard cost or inventory adjustments. The conclusion should identify the accounting impact, business cause, corrective action, and likely persistence of the variance. While answering, cover price, volume, mix, commodity costs, manufacturing efficiency, freight, promotions, foreign exchange, standard cost variances, and distinguishing temporary drivers from structural issues. Question 14. How would you calculate and analyze diluted earnings per share? Basic EPS divides income available to common shareholders by weighted average common shares outstanding. Diluted EPS additionally includes instruments that could become shares, such as options or restricted awards, but only when they are dilutive. For options, the treasury stock method assumes proceeds are used to repurchase shares. I would exclude anti-dilutive instruments, especially when earnings are negative. I would also check dividends, share count changes, and acquisition-related issuance before interpreting Kraft Heinz's EPS trend. Be sure to mention basic versus diluted shares, net income available to common shareholders, stock options, restricted awards, treasury stock method, anti-dilution, and the relationship to reported profitability. Question 15. You discover a material accrual error during the close. What would you do? First, I would preserve the evidence and verify the error against contracts, invoices, receiving records, and prior estimates. Then I would quantify the effect on expenses, liabilities, earnings, taxes, cash flow, and prior periods, considering both quantitative and qualitative materiality. I would promptly escalate to my manager and controllership, propose the correcting entry, and document the conclusion. Finally, I would identify why the control failed and recommend a preventive improvement rather than simply fixing one balance. In your answer, explain validating the facts, quantifying current and prior period effects, assessing materiality, escalating promptly, correcting entries, documenting evidence, and identifying the control improvement. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.